Good afternoon. Welcome to the Heritage Foundation and our Lewis Lehrman Auditorium. We, of course, welcome those who join us on all of these occasions on our heritage.org website. I'll remind our internet viewers that questions can be submitted via email to us at any time during the program, simply emailing us at speaker@heritage.org. We will, of course, post the program within 24 hours on our homepage for your future reference as well. And for those in-house, it's always nice for you to make that last courtesy check as we begin that cell phones have been turned off, especially for those who are recording our festivities today. Hosting our discussion is Norbert Michel. Dr. Michel is our research fellow in financial regulations in our Thomas A. Rowe Institute for Economic Policy Studies. He studies and writes about housing finance, including the reform of Fannie Mae and Freddie Mac. He also focuses on the best way to address difficulties at large financial companies, addressing that famous phrase, too big to fail. And he researches monetary policy and other issues related appropriately today to the Fed. Before joining Heritage, he was a tenured professor at Nichols State University College of Business, and he previously served here at Heritage as a tax policy analyst, and he has also worked with global energy company Entergy. He holds a doctorate degree in financial economics from the University of New Orleans and earned his Bachelor of Business Administration degree in finance and economics from Loyola University. Please join me in welcoming my colleague, Norbert Michel. Norbert?
Thank you very much, and we appreciate everybody coming out for the event and all who are watching online. This is an incredibly important issue, and institutionally it's one that Heritage has not been as engaged in as they are in some other issues, and that has all changed. And one of the reasons that that has all changed is our leadership has changed in a good direction, and we have Senator Jim DeMint, now our president, who is going to come up and give us a brief introduction.
Thank you, Norbert. I guess only the future will tell if it's changed in a good direction, but I know I stand on Ed Fulner's shoulders, so I take credit for nothing except this issue, and I'm so thankful that we're starting the debate here at Heritage. It seems that in Congress that there were only two kinds of people involved with this issue. It was those who weren't interested and didn't know anything about it, or those who approached it with some form of hysteria. And it was very difficult to get a discussion or debate going about our monetary policy, the Federal Reserve, and how it related to everything else we're doing. You don't have to think too long about monetary policy to realize that it is the foundation of all economic policy and actually the valuation of everything material we do in this country. And the fact that Congress, who has been given by the Constitution responsibility for our currency, does so little on it and understands so little about it, should cause every American to take pause at where we are. The Federal Reserve controls more about the markets and the economy than anyone in Congress does, yet they know very little about it and have no control over it effectively. Without making judgments on what the conclusion needs to be, at Heritage, we want to have an open debate and a discovery process about the Federal Reserve, America's monetary system, how that affects American economy and the global economy, which it very much does. Today we'll begin by looking a little bit at the history of the Federal Reserve, talk about monetary policy and what it is in its essence, and what are the next steps to begin to find out more about our whole monetary system, and what do we need to do to provide recommendations to Congress, which ultimately is where I hope we'll be at Heritage, is what should our monetary policy be, and what should our approach to the Federal Reserve be. So we're beginning that process today. And Norbert, I hope this is not the end, but the beginning of a discovery process, so that Heritage can help lead the way and where we should go with America's monetary policy. But I want to thank our guests particularly for being here today. We've got a lot of talent and expertise, so I look forward to watching this online myself, Norbert. So thank you very much.
I really hope it's not the end because I don't want to move again. So our first panelist is Dr. Larry White from George Mason. He's a professor of economics at George Mason, also a member of the Mercatus Center Financial Markets Working Group. And for those of you who don't know, he specializes in monetary theory and is one of the world's preeminent scholars on the theory and history of money and banking. He's the author of, among other books, The Clash of Economic Ideas, The Theory of Monetary Institutions, and Free Banking in Britain. He's also published numerous peer-reviewed journal articles in top-tier journals such as the American Economic Review, Journal of Economic Literature, and Journal of Money, Credit, and Banking. In 2008, Professor White received the Distinguished Scholar Award of the Association for Private Enterprise Education, and he is also an adjunct scholar at Cato, as well as a member of the Academic Advisory Council of the Institute of Economic Affairs. Very happy to have him here, and I'll turn it over to him.
Thank you, Norbert. I'm going to try to give you a kind of whirlwind tour through 100 years of Federal Reserve history so that we have the track record in front of us that we want to evaluate. If you go back to the foundation of the Fed, you find out that the Federal Reserve Act doesn't say anything about monetary policy. And this issue came up when Alan Greenspan was visiting The Daily Show, plugging the first book he wrote after he retired from the Fed. I believe the title was The Crisis Wasn't My Fault. And somebody wrote a very good question for Jon Stewart, which was to ask Alan Greenspan, if you believe in free markets, why do we have a Federal Reserve setting interest rates? And Greenspan's response was, well, that's a good question. And actually, you didn't need a central bank, I guess he meant to run a monetary policy, when we were on the gold standard, which was back in the 19th century. Well, actually, the gold standard continued at the time of the Federal Reserve Act being passed. So Greenspan was actually saying we didn't need to have a Federal Reserve to run monetary policy at the time the Federal Reserve Act was passed. Well, that's water over the dam. How well has the Fed done compared to the pre-Fed gold standard? That's one way to compare the Fed's track record to an alternative. There are other ways you could compare it to other leading central banks in the world, but that's the standard I'm going to use. And you see a dramatic change in the behavior of the price level almost immediately after the Federal Reserve gets up and running in 1914. Of course, something else happened in 1914, which was World War I began. And when World War I began, the major combatant nations in Europe all left the gold standard. So the international gold standard was pretty much kaput. And the constraint on the Federal Reserve System from international gold flows was pretty much neutralized, which meant the Fed now had a free hand to print money. And it did to support the Wilson administration's war efforts. And you see what happens to the behavior of the price level. It had been pretty much confined within a small range until the money printing to finance the war expenditures begins, and the price level jumps. If we think about it in terms of or look at it in terms of the inflation rate, I want to sort of break down the Fed's experience, the Fed's track record in terms of decades. You see the period of World War I on this slide, and it's characterized by inflation bumping around 20% and continuing at 20% even after the war ends, and actually reaching a peak of about 22% before there's a massive correction in 1921. And associated with that, of course, a very deep recession from which the economy rebounded pretty quickly. But you can see the period of actual deflation as part of the correction from the high price level created during the war. If you sort of measure the areas of inflation versus deflation, you can find out that the price level remained higher than it had been before the war began. So there was still inflation in the system that remained to be wrung out, and that would come later in the decade. But 22% inflation, not a very good starting point. The Fed's second decade, of course, was the Roaring '20s. And I'm not going to go into this point here, but I and some other economic historians think the Fed had some hand in amplifying the boom in the 1920s to the point where it couldn't be sustained. There was going to be a bust. But the recession that followed the bust, of course, became the Great Depression, which was much deeper than necessary just to correct the previous excesses. Milton Friedman and Anna Schwartz call this period the Great Contraction, where the money supply shrank a great deal, much more than necessary to restore equilibrium to the system. And so we had several years of 10% deflation, which put the economy through quite a wringer. The Roosevelt administration, together with Congress, decided to try to bring the price level back up by devaluing the dollar and taking the right of gold ownership away from U.S. citizens. They had to turn their gold into the Federal Reserve System so that the Fed would have more reserves on the basis of which it could issue more Federal Reserve notes. So that was the idea, and gold ownership remained illegal for several decades. But the U.S. then was officially, not only had the international gold standard had pretty much neutralized, but the U.S. was now off a domestic gold standard. There were still efforts to restore gold convertibility between central banks, so the U.S. could still pay gold or lose gold to other central banks in the world or gain gold from them. But the system that had been counted on when the Federal Reserve Act was passed to constrain the growth in the quantity of money in an appropriate way was pretty much non-functional now, and now it was up to the discretion of the Federal Reserve System how much money they wanted to create. The Depression the price level eventually recovers, but then the Depression is followed by World War II, during which inflation rises, of course, as money is being printed to buy the Treasury debt that's being used to finance the war. I mean, that didn't have to happen. You can fight a war with debt without monetizing the debt. But again, inflation reaches about 20% until price controls are imposed. And so there's a lot of inflation during World War II that's underreported. You couldn't actually buy things at the official prices. You needed a ration coupon. And even then, there wasn't enough to go around. When the price controls came off after the war, inflation shot up even more. You can see it reached nearly 20% again, until the Fed kind of took control of the money supply again, brought inflation down, and in 1951 came to an agreement with the U.S. Treasury that we are no longer bound by the wartime rules to monetize all the debt you want us to monetize. So the Fed gained a greater measure of independence in what's known as the accord between the Fed and the Treasury. And in the period following that, inflation came down and actually stayed fairly low and stable for the next decade. So the period from 1954 to 1964, not bad. Right? So I don't want to be accused of only heaping criticism on the Fed. It's actually a pretty remarkably stable and low inflation rate during this period. The website that generated these graphs keeps changing the scale on them, so it's hard to compare from one graph to another. You have to look at the numbers on the index, on the axis, to see that inflation's between 1% and 2% for several years. That's pretty good compared to the previous decades, certainly. But in the 60s, the Fed started to become more ambitious than just trying to keep inflation low and steady. And the result of that was the peacetime great inflation, where inflation rose up to 8%, came back down again, and then reached double digits. And on its way to double digits, finally a decision was made to put somebody in charge who knew how to fight inflation, and that was Paul Volcker. So it wasn't an accident that G. William Miller moved from the Fed to the Treasury and Paul Volcker was appointed. And you can see that he dramatically did bring inflation down. But it was a painful experience. And I think the reason it happened was that the Fed had sort of been inspired by the idea that a little bit of inflation can buy you a lot of unemployment relief. And if you look at the dates on these numbers, it's got the unemployment rate on the horizontal axis and the inflation rate on the vertical axis. This is the famous Phillips curve. It looked like there was a stable trade-off, and the Fed was working the trade-off. They kept reducing the unemployment rate, 65, 66, 67, 8, and 9, by increasing the inflation rate and getting the unemployment rate to fall a little bit more, although they were facing diminishing returns. But this trade-off turns out to be not sustainable. It only works if people don't anticipate the inflation that's coming, because when workers anticipate inflation, they'll start raising the wages they're holding out for, and it's going to take more inflation just to get the same rate of unemployment. That was the theory that Edmund Phelps and Milton Friedman presented in 67 and 68, while it still looked like there was a trade-off. So they got Nobel Prizes for foreseeing that it wasn't going to last. And here's the 1970s. There's the original short-run Phillips curve at the bottom, and suddenly the economy wasn't working the way it used to. Even the head of the Fed, Arthur Burns, in a speech said, the economy's not working the way the textbooks tell us. Inflation and unemployment are going up together. What do we do? Well, as his critics told him, and Milton Friedman told him, you do what you always need to do, which is control money growth, which Volcker eventually did. The period after the Volcker disinflation is another relatively mild period of Fed behavior as judged by the inflation rate. And again, or I should say that the inflation rate isn't a direct measure of what the Fed is doing, but it's an indirect measure, and it's something the Fed can control if they put their mind to it, so they can be held responsible for it. Not on a month-to-month basis, but on a year-by-year basis. Anyway, this 20-year period from 84 to somewhere around 2004 has become known as the Great Moderation, and there was a lot of optimism that the Fed had finally settled on the right model of the economy and now knew what to do. Now it was steering the ship in an appropriate way. The inflation rate was behaving itself not quite as well as it had in the 50s, but better than it had in the 60s and 70s. So there was a lot of optimism, and those of us who sort of started out as critics of the Fed weren't getting much of a hearing in those days because everything was going swimmingly. But then that all fell apart too. And what happened, of course, was the housing bubble or boom, followed by the Great Recession. And I'm going to argue that the housing boom, of course, it began during Greenspan's tenure, but it continued and then fell apart during the Bernanke era. And Bernanke came in as someone who was very concerned about combating deflation. He was worried, even when negative inflation wasn't evident or in the offing, to prevent it, and so encouraged Greenspan with very expansionary monetary policy. The irony is that in the middle of Bernanke's era, there's a period of deflation. At the beginning of the quantitative easing program, the Fed started paying interest on reserves, which led to banks bottling up so many bank reserves and therefore lending so much less. And that combined with the velocity of money slowing down, something the Fed's not responsible for, but which they should be offsetting if they could forecast better than they have. Anyway, irony of ironies, there's a very harmful deflation in the middle of Bernanke's tenure. In a congressional hearing, somebody was criticizing Bernanke for his inflation record, and he said, "I'll have you know I have the best inflation record of any Fed chairman." He must have meant the average rather than the variation, because if you throw in a year of negative inflation, you do bring down your average. But one way to diagnose what happened during this decade is in terms of the Taylor rule, which has become a kind of standard way of evaluating what the Fed is doing. Is it setting the interest rate target appropriately? And according to the Taylor rule, which kind of described the Great Moderation years, and so it seems to be a guideline to keeping problems contained, keeping inflation contained. Compared to that, the Fed held interest rates too low for too long. Right? So these parallel bands describe where the Fed funds rate, the overnight interest rate between banks, should have been in order to keep inflation within a certain range. But the Fed was keeping inflation much below that, inspired, I think, by Bernanke's fears of deflation. And the result of that was the housing bubble, because that made housing mortgage loans cheaper than they otherwise would have been. And it's true that this is a short-term interest rate, and most housing loans are long-term loans. But the proportion changed during the housing boom. More and more one-year adjustable rate mortgages were issued. And so housing finance became more sensitive to short-term interest rates because it was so much cheaper than financing long-term. If you look at the rates at which housing finance was expanding, it was at double-digit rates for a number of years. Well, if you are lending 10% more to the housing market every year, either house prices go up 10% or the quantity expands or both, and the U.S. economy was building more houses than were necessary, as we found out in retrospect, and housing projects had to be abandoned midway through completion. And part of the reason for this overexuberance in housing was housing regulatory policy, and many policies intended to put more people in owner-occupied housing. But the Fed provided the fuel for this, or provided the punch bowl for the party, made it possible to finance more housing than was really needed. During the crisis, and here I'm switching away from monetary policy for a minute, the Fed itself switched away from monetary policy exclusively or predominantly, and started pursuing what you might call credit allocation programs. And I had to shrink the type to fit all these on one page, and I even left a few out. But a long list of special directed lending programs for particular segments of the financial industry, and in some cases for a particular firm. The Bear Stearns case, AIG, got bailouts financed by the Fed. Citibank and Bank of America had special lines of credit. And at the end of the list, I have the quantitative easing programs 1 and 3, which have been described as monetary policy, defended as monetary policy by the Fed, but they're not monetary policy because they are purchases of mortgage-backed securities, which is an unusual asset for the Fed to acquire. And if you ask why are they buying mortgage-backed securities instead of Treasury securities, the usual thing they buy when they want to expand the money supply, the switch from Treasuries to mortgage-backed securities doesn't have any impact on the size of the change in monetary aggregates, but it changes what securities get purchased and what prices get supported. It was an attempt to support the price of a particular kind of financial asset, mortgage-backed securities, which the Fed thought was underpriced. So the Fed is substituting its judgment about how financial assets ought to be priced for the market's judgment. That's a credit allocation policy. They're trying to influence relative prices and the allocation of resources in the financial sector. That's not monetary policy. It's also not, and none of these items on the list are, lender of last resort policy, which is a traditional role of the Fed. The person who described this most classically was Walter Bagehot, and Bagehot's approach was, if you have centralized the reserves in your banking system, you don't need to do that, but if you have, then the holder of that reserve has a responsibility to make liquidity available to banks that are fundamentally solvent, but which are having temporary difficulties. So you're supposed to lend to illiquid banks short-term, but at a high interest rate to make them regret having gotten into trouble, and in order to make it clear that it's not going to be a subsidy operation. It's not supposed to make it comfortable for a bank to get into liquidity trouble. But that's not the way the Fed pursued it. The Fed lent at low interest rates during the financial crisis, one estimate of the implicit subsidy to the borrowers at the Fed's credit lines here was about $13 billion. If you look into the details, there are some things you can quibble with, but still, Fed was one of the cheapest lenders in town in some of these programs. And a more general point is that sort of making these policies up as they went along is not consistent with a kind of bedrock principle of a free society, which is the rule of law, which is people ought to be able to know in advance what the rules are going to be and to count on them being enforced impartially. The executive branch of government should not be playing favorites, deciding to make up new rules, deciding not to enforce old rules. Here's another piece of evidence that the QE policies are not monetary policy. If you look at the path of M2, which is a sort of standard measure of the money supply, it remains on a fairly smooth path at the same time that the monetary base, the Fed's balance sheet liabilities, are jumping. So the first jump is QE1, then the next jump is QE2, and then the ongoing jump we're in now is QE3. So those don't change the monetary aggregates. So it's not a monetary policy. It's not designed to change the path of the money supply. It's a credit allocation policy to raise the price of mortgage-backed securities. So let me wrap it up by going back to what I said I was going to do, which was compare the Fed's track record to the gold standard's track record. During the pre-Fed period, which is shown in gold here, the price level ends at almost exactly where it began. So in 1914, it's the same as what it was in 1879. The average inflation rate is within a hair of zero. But between 71 and 2013, the average inflation rate's been over 4%. So that's quite a difference. The Fed's been worse on inflation. This one's a little more subtle, but the Fed has created more uncertainty about what the future value of the dollar is going to be, where the price level is going to be 5, 10, 20, 30 years from now. That discourages long-term investments because it makes it harder to issue long-term bonds. There aren't going to be as many buyers for a 30-year bond if you don't know what the dollar is going to be worth 30 years from now. And so a paper that George Selgin and Bill Lestraps and I published in 2012 has these measures of uncertainty which show uncertainty higher today than it was in the pre-Fed period. A lot of people defend the Fed by saying, okay, inflation's higher, but haven't we smoothed out the business cycle? And the answer is no, you haven't. Certainly not over the Fed's entire history, because remember, the Great Depression happened under the Fed's watch. Okay, maybe the Great Depression is just a practice period. That shouldn't count against the Fed. I stole that joke from George. But even if you take out the Great Depression and just start in the post-war period, you find that the volatility of the real economy is basically back to where it was in the pre-Fed period, despite the economy being much better diversified, much less agricultural. And so it seems like the Fed has made a negative contribution if you think of the economy on its own would have been more stable. Lastly, one reason people give for leaving the gold standard was we save all the resources it takes to dig gold out of the ground. We haven't even done that because we've made the price level so unstable, people now buy gold as an inflation hedge. The real price of gold is higher now than when we were on the gold standard. Let that sink in. So there's more gold mining now for people to buy bars and Krugerrands and coins to store in their safety deposit boxes or in their backyards. And finally, the Fed hasn't reduced unemployment. Now, you shouldn't expect them to, because unemployment is not the sort of variable that depends on the price level for the reasons that Friedman and Phelps gave us. So, summary, the Fed hasn't improved over the pre-Fed period. It hasn't delivered the benefits that we could have hoped for. And it's added moral hazard to the system through its bailout policies, its not run a monetary policy that has given us benefits. It's raised inflation and it's not smoothed out business cycles. So how could we get better results? Well, here's an analogy I thought of last night. Maybe I shouldn't should think about it more, but here it is. The Federal Reserve System is like a early 20th century locomotive that was designed with a self-governing engine, the gold standard. But early in its history, the self-governing engine was replaced by strapping some rockets on the train, right, the ability to print money at lib. That leads to a train that has a great danger of jumping off the tracks if the rockets aren't really precisely controlled. So what do you do about that? Well, you could remove the rockets, try to go back to a self-governing monetary system. If that's politically impossible, you might try to think about strengthening the rails that the locomotive is running on so it doesn't jump the tracks so much. What would that mean? That would mean imposing some kind of rule on Federal Reserve monetary policy, either a Taylor rule or a price level target, or better than that, a nominal income target. I don't have time to go into the details of those, but there are various ways we could think about making Fed policy more predictable and less discretionary. And I will quit there. Thank you.
Thank you, Larry. Our next presentation is by George Selgin. Professor Selgin is at the University of Georgia's Terry College of Business. He is also a senior fellow at the Cato Institute, and he too specializes in monetary theory and is one of the world's preeminent scholars on the theory and history of money and banking. Dr. Selgin's research covers a broad range of topics within the field, including the history of monetary thought, monetary history, and macroeconomic theory. He is the author of, among other books, The Theory of Free Banking, Money Supply Under Competitive Note Issue, and also Bank Deregulation and Monetary Order. He, too, has written numerous articles that have appeared in top-tier academic journals, and he is also a co-editor of Econ Journal Watch. And I'll turn it over to George.
Well, the first thing I need to do is to find my slides.
Just keep pressing. Just keep going.
Keep pressing. Oh, they just come next. I'm sorry about that.
That's all right.
Let's see. Slideshow. Which one is that? That's all right. My mistake.
There's a really good PhD joke in here somewhere.
We have to go to slideshow. Here it is. There we go. Okay. Ah, here we are. That wasn't so bad. Right, Larry, thank you all, by the way, for giving me a chance to talk about how the Fed manages to give people the impression that it's been doing a wonderful job. Larry referred to our joint work with my colleague Bill Straps on how the Fed has actually performed in its first 100 years, and he gave you he summarized some of the results of that work. Suffice to say that in terms of price level stability, predictability, business cycle fluctuations, crises, and banking failures, things have not been better since the Fed's establishment than they were in the decades preceding the Fed's establishment. And that fact is all the more important when you consider that the banking system we had before the Fed's establishment was crummy. I'll talk a little bit about it. So it's not a question that we couldn't do any better than we did before 1914, not at all. But we've done worse, and that certainly is a very unfortunate record. Now, the thing I want to talk about is how the Fed has managed to convince so many people that it has done a very good job, that it's accomplished its mission, and it has achieved that result. The Fed's reputation is actually rather high, although, of course, there are plenty of us who criticize it. There are many more people who insist that it's doing a great job. And this is, to a considerable extent, the result of the Fed's own very successful propaganda efforts. And it's those efforts I want to talk about. What those efforts amount to is creating a myth, a mythology, as it were, of a U.S. monetary history, including the history of the period before the creation of the Federal Reserve. And what I want to do is to point out some of the ways in which the Fed's propaganda misrepresents that history and does so in a way that makes the Fed appear to be a much more successful institution than it actually has been in fact. One of the first pieces of propaganda that's very crucial to this effort is the claim that before the Fed, and particularly before the Civil War, banks simply weren't regulated, and therefore the problems with the antebellum banking system were consequences of a lack of regulation, and particularly a lack of federal regulation. In fact, that's not true at all. As Bray Hammond, who's the most prominent, the most famous historian of antebellum banking in the United States, has pointed out, banking has been regulated from the very beginning of U.S. history, and very strictly regulated. As he put it in his famous book on banks and politics before the Civil War, the issue, at least until 1836, was between prohibition and state control with no thought of free enterprise. And this is coming from someone who's not himself necessarily a fan of free enterprise or laissez-faire, but the facts are that no state allowed freedom of entry and freedom from regulation of its banks. And many, as the quote points out, prohibited banking altogether. One thing that almost all states did, though some in the South were exceptions, was to prohibit any kind of branch banking. Not only did states jealously prevent out-of-state banks from doing business across their borders, but they generally also didn't allow their own banks to set up any branches. Every bank was a unit bank or a one-office bank. This fact alone was a source of tremendous weakness in the U.S. banking system, because the banks in question naturally could not diversify their assets or, for that matter, their liabilities. And that single fact alone was probably one of the most potent causes of failures in the banking industry in the United States right up until the Great Depression and even to some extent afterwards. Now, another consequence of the fact that banks couldn't branch was the lack of a uniform currency. Now, the Federal Reserve, one of the Federal Reserve banks has a video, which I show a shot of here, of a couple farmers trying to do a deal involving, I think, a horse, and staring at a batch of non-uniform banknotes trying to figure out what it's all worth. And, well, that was a problem before the Civil War, but what the Fed doesn't tell you in any of its propaganda was that this was not a natural consequence of lacking a single source of currency, which is how the Fed makes it seem. It's simply the fact that banks couldn't branch, so when their notes traveled far from their single offices, they would tend to go to a discount reflecting the cost of trying to get them back to where they could be redeemed in silver or in gold. Countries that had many banks, that is, competing banks, but that also had branching, like Scotland and Canada, in fact, to bring a closer to home example to bear, they had uniform currencies, well, even when they didn't have monopoly banks of issue, when they had competition with multiple brands of banknote currency, all circulating at their full gold values, because there was always a nearby branch where they could be redeemed. On the eve of the Civil War, or in this case a little bit into the Civil War, the discounts on state banknotes, despite the lack of branch facilities, had actually fallen quite a bit. These are calculations I did myself. I'm sorry, the numbers aren't legible for you for the most part, but suffice to say that if you bought up every state banknote in the North, the South at this point, the banks are basically out of business, and brought them all to a central market like New York or Chicago and sold them for what gold you could get from a broker there. Having paid full face value for the notes, your loss would have been less than 1% of that face value. Now, I mention this because Fed apologists and unfortunately other historians who followed their lead argue that we had to get rid of the state banks and nationalize the currency system because of this non-uniform currency. Moreover, they argue that that's exactly why this was done during the Civil War. During the Civil War, national banks were set up that were nationally chartered, and they got the right to issue notes under specific circumstances that I'll mention in a moment. And subsequent to that legislation, state banks were taxed out of the currency business by prohibitive tax. But this wasn't because the currency wasn't uniform. You can see that that problem wasn't so severe by the Civil War. And indeed, state banks would have continued in business in many regions of the country and were competing effectively with national banks until that prohibitive tax put them out of business. The reason for the whole thing was to finance the Civil War. And you can understand that more readily if you realize that a condition for national banks to issue currency was that the currency had to be backed 110% by U.S. government securities. The idea was to have a captive market for bonds, Union bonds, so that the war could be financed. It wasn't, as is so often the case with financial legislation and U.S. financial legislation in particular, it wasn't a case of trying to provide a better monetary system. It was a case of fiscal emergencies driving monetary legislation, even when the consequences for the monetary system, especially in peacetime, were not so great. Now, in this case, the consequences were not so great, specifically because after the Civil War, we had some of our most calamitous financial panics. And these are the panics that famously led to the creation of the Fed. And the Federal Reserve System publications, of course, emphasize the fact that, as this quote says, bank runs and financial panics continued to plague the nation after the Civil War. What they don't tell you is that the reason for these panics was the bond requirement that meant that the supply of currency was now linked to outstanding government debt. If the government retired its debt, if it retired at all, the total supply of national banknotes would have had to fall to zero. So the scarcity of government debt, which became greater and greater in the last decades of the 19th century as the U.S. government ran surpluses and retired its debt, something we'd normally like to see happen, meant that the country was occasionally deprived of adequate supplies of currency. Now, the other thing that these Fed propaganda sources will tell you is that only a central bank could solve the problem. In fact, the way some of them put them, as in this other quote, the way they express the problem is that it was the problem of the absence of a central bank. Well, of course, if you put it that way, then the solution is, hey, presto, a central bank. Well, let's see. Here is a graph showing you, first, the smoother line. That's the stock of national banknotes starting in 1880. And as you can see, it's shrinking dramatically from a peak of just about 350 million to less than half that amount. In a growing economy, you can imagine this was not a healthy situation. Worse still was the fact that the supply couldn't at all adjust seasonally. And in those days, there was a tremendous peak demand for currency every harvest season. Now, the Fed wants you to believe that this was an inherent problem of not having a central bank, that only a central bank could solve. Oh, but wait. What's this other plot? That's the plot of the supply of currency in Canada, our northern neighbor, during the same period. It shows not only secular growth, consistent with the fact that Canada, too, was a growing economy, but lovely seasonal peaks. Why, here's a currency supply that surely must be being administered by a central bank. Those Canadians must have gotten the idea before we were smart enough to get round to it. Oh, except that Canada didn't have a central bank until 1935. What it has is a competitive system of large nationally branched banks, which besides supplying currency that seems to adjust in supply, just as a perfect central planner might adjust it, but not as our true monetary central planners have ever been capable of adjusting currency, but that also was remarkably robust. There were no crises in Canada. Therefore, no movement to create a central bank until during the Great Depression, when, incidentally, the creation of the Bank of Canada was not because the previous system had caused problems as great as in the United States. Canada, in fact, had 0 bank failures during the Great Depression. Set up the Bank of Canada for, well, that's the subject of another talk. American reformers were very conscious, by the way, before the creation of the Fed, of the advantages of the Canadian-style system, and they tried through numerous pieces of legislation to get a system like it into existence for the U.S. The Baltimore Plan, the Carlisle Plan, the Gage Plan, the Fowler Plan, all of them ran afoul of unit banking opposition and also the opposition from Wall Street, which interestingly enough was aligned with the unit bankers. Why? Because when the country bankers needed access to the New York money market, they had no choice but to deal with Wall Street correspondents. So the status quo system was as lucrative or more lucrative for Wall Street than it was for the country bankers themselves. So this odd coalition fought any reform that would have introduced nationwide branch banking. Also, the populists, and let's not forget that William Jennings Bryan was Treasury Secretary under Wilson, put the kibosh to any plan that would have allowed private banks to continue to remain to be responsible for controlling currency. They wanted government to handle it all. So we got the Federal Reserve Act, not a first best solution to our problems, not the second best, probably the third, fourth, or fifth best. You could think of every one of those other plans as having been wiser than this one, if not politically easier to get through. Here's how Ben Bernanke in his George Washington University lecture recently summarized the story that I just presented to you. It was simply, in his view, after 1907, Congress began to say, well, wait a minute, maybe we need to do something about this, meaning all these crises. Maybe we need a central bank. Well, that's nice and short, but it gives a quite misleading impression of what the true alternatives were. Now, oh gosh, I'm going to run out of time, of course, because I'm trying to summarize Fed propaganda, and that could take forever. But I'll do at least a little bit more. One of the things that the Federal Reserve publications like to ballyhoo about the Fed is how independent it is. Well, the Fed's never been independent in any meaningful sense. When it was first formed, the Secretary of the Treasury and the Controller of the Currency were, respectively, President and Vice President of the Federal Reserve Board. And believe me, they had some say. Larry already explained to you how they got the Fed to finance World War I by generating over 20% monthly inflation rates for a while. This control of the Fed by fiscal forces by the Treasury continued very clearly right up through World War II, when the Fed was still handmade into the Treasury. Now, there's a myth, again perpetuated by the Fed, that in 1951 a Treasury accord was arrived at. Of course, that's true. And this accord ended the Fed's being pressured by or influenced by the Treasury, being mere handmade into the Treasury and so on. One Fed source even credits McChesney Martin with battling for the accord on the Fed's part. Well, one problem with that is that Martin was involved in the negotiations, but for the Treasury. He was not at the Fed. He was rewarded with the chairmanship of the Fed by Truman, who was so annoyed about the accord that the previous Fed chairman had reached, Thomas McCabe, that he fired him and gave McChesney Martin the job. And here you have the Fed saying that McChesney Martin got the Fed from under the Treasury's thumb. But Martin himself subscribed to what he later called the notion of independence for the Fed within government. That's what he called it. And I'll tell you exactly what this means. It meant that the Fed could be independent so long as it did whatever the administration wanted it to do. And there were actually memos in Arthur Burns' diaries. You can read places where he says things like, well, to the Fed board, we've got to do what Nixon wants or whatever, because this would be Burns talking, but there are many other instances from Martin as well. We've got to do what the administration wants because they're threatening to take away our independence if we don't. So there's Fed independence for you. Even Volcker, Volcker's anti-inflation campaign had nothing to do with Fed independence. It was simply the fact that at that time, the administration, and Carter's administration too, which appointed Volcker, had turned their focus to fighting inflation. So now the Fed was still doing the administration's bidding. It just so happened that it was not inflating for it, it was disinflating. The way the Fed, 2 minutes, oh great. The way the Fed tries to say that its performance has actually been successful with regard to such things as price level stability, well, it has to be very careful, of course, because there are actually statistics about this sort of thing, you know. But here's an example. I think this is from the Atlanta Fed, Jerry. One Fed publications, fluctuations in the purchasing power of gold, this is by way of saying that the old system wasn't any good, made gold a poor standard on which to base our measure of value. And that made trade difficult since no one knew what a dollar would buy from day to day. The publication goes on to say, when we finally got away from the gold standard, finally we could have a stable value, a measure of value. Well, maybe we could, but we didn't. as you can see from this chart, which I think Larry has already shown you. The other thing the Fed does with regard to claims about being successful at dealing with inflation is to treat inflation as some kind of problem that invades the economy from without. So the Fed is always fighting the inflation. Right, here you have a typical example. It's this cartoon. There's inflation, the big red blob. There's the Fed, Superman, jamming his elbow into it, trying to get that inflation out of the system. Another Federal Reserve Bank of Atlanta publication. If the price level begins to rise, central banks like the Fed will try to adjust monetary policy in order to slow this advance. If the price level begins to rise, well, how come it's beginning to rise? Who did that? I was going to talk about deflation. Let's just suffice to say that sometimes deflation is good. Well, it was good mostly when it happened before the Fed. But there are bad deflations that involve collapses of spending. All the worst ones have happened since the Fed. This episode comes to mind as another problem for the Fed. Oh, bank crises. Oh, goodness. They like to talk, Bernanke in his George Washington University lecture talks about what I now call the Frank Capra theory of bank crises. The crises happen because everybody panics, runs on the bank, and then what do you do? But if you have a good central bank, it can come to the rescue. And he actually uses Frank Capra's movie to draw his illustration of how this sort of thing can happen. It's a good reason for that. There have never been random panics in U.S. history, not even in the 30s. The big run in 1933 was a panic, all right, but it was because people suddenly realized that FDR might devalue the dollar, so they were running on gold. In any event, the Fed wasn't legally allowed to bail out building and loan associations, so it couldn't possibly have done Bailey's Bank any good, and it didn't do many banks any good, as we all know, even though the Fed was there during the Great Depression and was supposed to stop runs. Here's a record of actual bank failures in the U.S. You can do this either by total number of failures or by deposits. Look what happens. It's actually worse after the creation of the Fed. Now, it's not all the Fed's fault, of course. There's lots going on, mainly problems in agriculture. But for the Fed to claim that it's improved things, it would have to explain why these numbers go way up after 1914, not down. Now, after 1934, for many years, you have fewer bank failures. But that's not the Fed. That's the FDIC, and before it, the RFC, pardon me. Continental Illinois, well, deposit insurance would eventually create a big moral hazard problem, especially after the repeal of Regulation Q, but far worse was the doctrine of too big to fail, which really starts with the bailout of Continental Illinois Bank in Chicago in 1984. And that's what I wanted to add to what Larry had to say about the Fed's conduct in the crisis. The Fed's behavior in the crisis, among other things it did wrong, was to not act according to the classical notion of the lender of last resort. Now, the Fed, and Bernanke in particular, pay a lot of lip service to Badgett, to lend at a high rate freely on good collateral. But the whole idea of Badgett's rule is that you're not going to hold out the hope of a rescue for any insolvent institutions. Now, the problem wasn't that the Fed only bailed out obviously insolvent institutions. In fact, from that perspective, it seems to have done the right thing. It bailed out Bear, but Bear might have been solvent. But it didn't. But then it didn't bail out Lehrman, which was definitely insolvent. The problem, though, is what they said when they bailed out Bear. When they bailed out Bear, Geithner, Bernanke, others, they all said, we're doing this because it's big and systematically important. They didn't say we're doing this only because it's solvent. That was too big to fail. As soon as that doctrine was made clearly the basis for the rescue, of course, Lehman's and every other bank or financial institution that was bigger than Bear had every reason to think that whether it was solvent or not, it was going to get bailed out, and the creditors acted accordingly. So when they didn't get bailed out, of course, the disaster was huge. Larry talked about this. I'm going to skip a bunch of stuff, but I did want to talk about this claim, right? The Fed's, one of the biggest propaganda successes of the Fed, if I have time, 1 minute, was to claim that it has done a great job combating the recent crisis and expediting recovery. I'm reminded of an episode from the Beverly Hillbillies, and I see at least a few people here who probably watched that show a few times, where the word gets out that Granny has a cure for the common cold. And the whole episode is spent with people trying to get the cure out of her because, of course, they can really make hay with it. But then at the very end, finally, Granny fesses up and she says, yes, you just take some of this potion and in a week to 10 days, you're going to be good as new. The difference is that the recovery from the recent crisis has been one of the worst recoveries ever. It's been extremely slow, whether you measure by the rate at which output recovered or, worse still, the rate at which employment recovered. There's never been a recovery worse than this. Never. Nothing like it. And, of course, the implication is, and it's especially true if you go back and look at 19th century crises, that doing nothing would have been better than what the Fed did. At least there's no reason to think otherwise. And yet we have economists who claim that if it hadn't been for the Fed, we would have had another Great Depression. This is a counsel of despair, of course. If you cannot claim that the Fed did if the Fed creates the second worst crisis in U.S. history, instead of calling that a bad thing, you refer to the first worst crisis in order to claim that this was actually a success. This is what I call making lemonades out of your very worst lemon. Thank you very much.
Thank you, George. Our next panelist is Dr. Jerry Dwyer, who is currently a visiting professor and BB&T scholar at Clemson, as well as an adjunct at the University of Carlos III in Madrid and also at Trinity College in Dublin. And although this is going to sound like we played some sort of really cruel joke on Jerry, it's not true. He's a very good guy. But he's a former Fed employee. So he's a former vice president at the Federal Reserve Bank of Atlanta, where he was also the director of Center for Financial Innovation and Stability, where he retired in 2012. So we're very happy to have Jerry here, and I'll turn it over to him. And then, and when Jerry's done, we will have a little bit of time for questions from the audience. So.
Thank you. Oops. How do I do it? Oh, just down. Oh, there we go. Okay. Yeah, I'm not really sure. I mean, what's the right word? I'm pretty libertarian, actually, you know? And in some ways I feel like, well, I've been invited into the lion's den. But I don't really feel that way. I mean, I don't know. You'll find out what I think about stuff. That's about what I can say. If this means anything to you, sometimes I've been introduced as Milton Friedman's last student. You know, after me, he quit. So make of it what you want. What I was asked to talk about was the Federal Reserve, what they did in the financial crisis, and how they handled it all. And I view that as a brief. Now that I'm not at the Federal Reserve, it lets me say, well, what do I think about the various things that were done? What are the arguments that can be made one side or the other? And you can decide what you think about the various things. And different people come to different conclusions about a lot of things. And the fact of the matter is, in the end of the day, you can't really even imagine conclusive proof, evidence about whether something's correct or incorrect. A lot of discussions are about counterfactuals, and I'll discuss them in the sense of, well, if you'd done something different, then something different would have happened. The answer is we don't really know for sure what would have happened because we haven't run that version of the world, nor can we. And so the Fed has done a lot of things. You know, they bailed out some of the creditors in Bear Stearns. They let Lehman Brothers go into bankruptcy. They bailed out some creditors in AIG, mostly foreign banks. They've had a lot of programs to provide funds to banks and other firms. You have the Trouble Asset Relief Program, which nobody's mentioned yet. The Federal Reserve was involved in doing that in the sense that Bernanke was sitting at the table when they were twisting banks' arms to take funds. In quantitative easing, I view that as part of the response to the financial crisis. You don't have to, but I do. So I'm going to talk about all those things. What I want to do is start off with the beginning in a way so that we kind of remember how this happened. Let's leave aside the low interest rate stuff. Maybe that's correct, maybe it's not correct. Again, that's a counterfactual and there's actually not a lot of evidence. But we can be sure of one thing, that the financial crisis revolved around housing. It actually also revolved around securities. all right? Specific securities, actually, what are called collateralized debt obligations, backed by subprime mortgages. This figure is actually the prices of these securities from the beginning of 2006 through 2012. And what it shows is these are rated, all right, there's 4 graphs. That's just to provide some idea of the variety. I don't want to go into the details of the graph because it would take us afield. But the fact is that you can see on the graph there's securities with different ratings. And for example, some of the securities, AAA, that's the one at the top, all the way across in all of these graphs, they fell by 20%, 60%, over 60%, 80%. A lot of securities that were AA in 2007 became totally worthless by the time you get to 2009. All of these are backed by subprime mortgages. All right? I'm not saying this caused the crisis, that's for sure, because it's a consequence of the crisis. But it shows these securities were intimately involved in the way it unfolded. And I'll explain that. This graph shows what's LIBOR, which is the London Interbank Borrowing Rate, which is famous right now for some manipulation and other stuff. Okay, let's leave that aside. Minus what's called the overnight index swap rate. So what is the graph showing? This is intended to be a measure of the perceived riskiness of lending to banks. All right? And so I'm using that graph for this purpose. You can see early on, 2006, first half of 2007, it's really close to 0. This is really just marginal risk, transactions costs. And then 2009 onwards, it's a lot lower, not as low as it was before, but it's pretty low. And in between, it's got some really big spikes. Those spikes are informative about various developments and how important they were. What were those developments? The first thing that happened is August 9th, 2007. What happened on August 9th, 2007? Why would I even mention that? BNP Paribas actually suspended redemptions in a fund that it had that was holding these securities that I just showed you. The ECB provided funds to BNP Paribas, which is a French bank. Then what's the next big jump? That big jump, it's a run on a bank in the UK called Northern Rock. And in fact, it failed. And the English government still owns it, as a matter of fact. What's the next big peak? Well, it was the end of the year, actually. And then what is after that? After that is really what we think of as the crisis. September 16th, 2008, there's a huge jump. And then there's another big jump. That's the run on the money market funds. I'm going to argue that's actually central to understanding the financial crisis. All right? You may not have thought about it, or you may have thought about it, or you may already think it's a central thing, but I'm going to argue that it is central to understanding the developments and what the Fed do and what they didn't do. What's related to that, in an set of interest rates I'm going to focus on more, actually, from now on, now that I've got the dates, is commercial paper rates. That's rates at which firms borrow on a short-term basis. This is 30-day commercial paper. So they borrow for 30 days. And the other thing it shows is Treasury security rates. The blue line there on the bottom, or gray, whichever, I'm color challenged, is the Treasury rate. And you can see the commercial paper rates are ticking up on certain dates, like August 9th, 2007, which I just brought up. Treasury rates actually drop. It's what's called a flight to quality. People bailed out of commercial paper and said, wow, I really want to be in Treasury securities. Maybe they're not very good long term, but on a short term basis, if I buy a Treasury security, they're what I call nominally risk free. What it means is that if the government promises to pay me $100, they will pay me $100. Now what it'll buy, that's a different question, you know. But I'll get my $100 at least. Whereas with commercial paper, you may not get your $100. But you can see the same developments, the run on Northern Rock, the end of the year, the run on the money market funds. Okay, so these things had implications through financial markets and the way it developed and everything else. The reason I mention those two things in combination is because a key aspect of the financial crisis was people couldn't figure out who was solvent and who was not. Why? Because they were holding these collateralized debt obligations and they weren't sure what they were worth. All right? I have a couple of papers related to this issue. You know, and I'm happy to provide them, of course. I'm always willing to advertise. But people were concerned about the solvency of institutions. That made them concerned about lending. That's why you have this LIBOR less OIS going up. The run on Northern Rock got people concerned. Northern Rock did not hold these securities, by the way. It did make mortgages in the UK. Government investment funds in the U.S. The Florida government pool was like a money market fund, all right? And they held some of these securities, actually, and they went down in value, and they actually had a run. I had no idea there was such a thing as government investment pools until the run on the Florida one. And I was at the Atlanta Fed, you know, Florida's not that far away, and it's in the district. Bear Stearns, there's firms called monoline insurers. There's not firms that just sell one kind of insurance. Monoline insurers actually guarantee municipal debt. But they were also issuing collateral credit default swaps related to these securities. So they became insolvent. The credit rating agencies, when you look at something like AAA securities, and over the course of a year and a half, they fall by 80%, you start to wonder, well, what are the credit rating agencies doing? Now, these are different securities. I don't want to, everybody loves to hate the credit rating agencies. There's not a financial economist out there, except maybe me, who doesn't want to pile on them. Okay? Bear Stearns was taken over by JP Morgan Chase with Fed involvement, which they still have some stuff on their books, in March of 2008. Fannie and Freddie were put into conservatorship on September 7th, 2008. There were government-sponsored enterprises. Everybody thought nothing could possibly go wrong there. Well, they were holding securities related to subprime mortgages. Woo-hoo! September 15th, the Bank of America announces the purchase of Merrill Lynch. Lehman Brothers files for bankruptcy, and that's when everything went really bad. September 16th, AIG was given $85 billion in a, quote, bridge loan, end quote, by the Fed, and Reserve Primary Fund breaks the buck, okay? The Reserve Primary Fund is related to those developments up above. Reserve Primary Fund, it was a money market fund. Prime funds hold commercial paper in addition to holding treasury securities, and then you have treasury funds that only held treasury securities. So they were holding Lehman paper. Lehman files for bankruptcy. That paper is not worth what it was before. It doesn't take a big difference, a big fall in value. If you say, well, this money market fund, they'll pay me $1. Well, they have losses. Maybe if I wait a week, I'll only get 99 cents. Well, take the $1. Why would you want to wait to get 99 cents later? So everybody wants to take their money out now. And so basically what you get is a run on the money market fund, and that is what you got. It wasn't a big loss. What Reserve Primary Fund did was they actually calculated, okay, suppose that the Lehman Brothers paper is worthless. Then how much are our assets worth? It was 97 cents on the dollar. All right, so it wasn't like it was 50 cents on the dollar or anything like that. But it doesn't take very much. It's just like a bank, actually, you know, is if you think they might not have the money, you want to be the first one in line. This is a picture from the Depression that runs on banks. You want to be there early. You want to be there and you want to get your money out of the bank. And if other people don't get all their money, well, it's their problem. You know, you feel bad for them, but it's not going to make you wait until after they get their money. The run on the money market funds was like that. There were no lines like that. Money market funds don't operate that way where you go into the office and get your funds and all of that. What you do is you call them up. Or in fact, what you do now is you just go online, transfer the funds from your money market account to your bank account. You're out of there. You're in great shape. This graph shows the run on the money market funds in the only graphic way you really can, which is the change in the quantities in the money market funds. There's a total there, all right, that only goes down a little actually. So it wasn't a run on funds in general, but it was a run on prime funds. That's the line in the middle. You can see it dips down. That vertical line is the failure of Lehman Brothers, bankruptcy filing to be precise. And the money market funds, the funds in them went down. Government funds went up. People said, oh, you're holding treasury securities, I'll get my money. Oh, you're holding commercial paper, maybe I'll get my money, maybe I won't. I think I like getting it for sure better. This showed up in interest rates. This is the graph I showed you before, but what I want to highlight is you have that big spike with the run on money market funds. So you had a big increase in commercial paper rates, and you had a decrease in treasury rates basically down to zero. If I could get my dollar back 30 days from now, hey, that's good. By the time you got to the middle of September in 2008. You know, this is at a time, remember, stock market ended up, it didn't go down that week this much, but it did end up going down in the U.S. The stock market in the U.S. went down almost 50%. You know, so people watch their retirement accounts evaporating, and so it's like treasury paper looks pretty good. And so you have this run, and it's showing through interest rates. That is, it's not the case it's like a run on the money market prime money market funds, and that's the end of it, you know, and it's really tough for the prime money market funds or for the people who have deposits in it, but it's affecting financial markets as well. It's affecting treasury rates, it's affecting commercial paper rates, you know. Now, there's an argument you can make. I have a little bit of trouble with this in the following way. Well, let's look at the graph. So there's a big increase in this interest rate that we're looking at here. It's up to 6%. It's like, that's a big rate? Doesn't sound all that big. Now, what we were hearing at the time, I have trouble with this as an economist. What people were saying was, well, they were locked out of the market. That is, we couldn't borrow at any rate. Why were people borrowing? You know, I have trouble with that in the sense, look, at some interest rate people will loan to you. A loan shark will give you money if nobody else will. Now, if you're treasurer of not GM, God forbid, but I don't mean them. But if you're treasurer of General Electric, for example, you probably don't want to go to a loan shark. Doesn't really sound like a good deal. So firms were having trouble borrowing. They borrow in commercial paper to do things like make payroll. They borrow in commercial paper to do things like pay for goods that they've bought so that they can make other things. That is, it's all very disruptive. You know, now in and of itself, well, life itself is disruptive, you know. But on the other hand, this is a significant event in the economy, and maybe you can do something about it, and it's not as big. Certain things, anyway. Now, why did the Federal Reserve do anything at all? All right, you could argue the Federal Reserve was a mistake from day zero. I don't want to go there at the moment. Well, it's just not the topic I'm supposed to talk about. You know, I was kidding earlier, sort of. Somebody said, you know, well, professors, they always talk too long anyway. And it's like, I always tell people, look, you know, you tell me whether you want 50 minutes or an hour and 15 minutes, I can do either one. You know, shorter than that? Oh, I don't know. But, so the Fed was created to do something about banking panics. Now, the Great Depression, without a doubt, was partly the Federal Reserve's fault. All right, but let's leave that aside. The thing is that when people in the U.S., you know, at least my age even, certainly my mother's age, when they think about the financial, when my mother thought about the financial crisis, what my mother thought was, oh no, this is like the start of the Depression. You know, now obviously I have gray hair, so my mother was relatively old too. All right, but nonetheless, it's what we think of anymore because we don't have these little crises, little banking panics, crises, whatever you want to call them, that we used to have before. Used to have them every 10 or 20 years, for better or for worse. So the Federal Reserve intervened. Now, what was one of the effects of what they did? One of the effects of what they did, this is a table from some stuff I did with Jim Lothian, and it's hard without using a pointer or moving around or something. Let's see. Here, I'll move around, it's easiest. You just have to look over here and realize what I want to point to is I want to point to the middle column. This number down at the bottom is the figure for the U.S. It's how big was the contraction during the recession in the United States, minus 5.64%. All right. Now, suppose we compare that to the contractions, not before the Federal Reserve, 3 of them, and with the Great Depression. All right. What we see is that this contraction was minus 5.64. The severe business cycles with runs on banks before the Great Depression, before the creation of the Federal Reserve, are 1.83, minus 11.75, that's much bigger, minus 12.58, that's much bigger. That is, the declines in real GNP were much bigger. And then the Depression, of course, that was really horrible. And so the decline in real GNP for having a severe banking crisis was relatively small, all right? Now, maybe that's the Federal Reserve, maybe not. I'm going to argue it was in part, actually. If we look at what led to all of this, part of what led to all of this is this is the unemployment rate. It shows what was talked about before, the great moderation, pretty clearly. Is you see these blue lines, those are recessions. And if you look from 1980 up to 2008, well, there aren't very many recessions, all right? The increases in unemployment aren't particularly big or really big. Now, of course, when we get to 2008, that's really bad. And so we had this period that was relatively quiet and calm, and then we had a big increase. Now, one of the things that's happened is we can look and see one of the things that monetary policy, at least from my point of view, is supposed to do is control the growth rate of the money supply and make it consistent with, in some sense, I don't want to get into it at the moment, in some sense with reasonable behavior by the economy. What might it do during a financial crisis or a run on banks? I got 2 minutes. Is keep the growth rate of the money supply from falling like it did during the Depression. All right, you can see here, this is from 2007 to 2013. The growth rate of the money supply is kind of knocking around. It actually went up a little bit after the financial crisis, but it's pretty steady. You wouldn't really know, oh, this is the only financial crisis of my life occurred during this period. It's really pretty steady, you know. Arguably, that's one of the reasons why the decline in real GNP wasn't as bad as it could have been otherwise. Now, the monetary base is something else again. This I'll come back to. I'm only going to have 2 minutes, so I'm going to talk about it really quickly. Is the monetary base, this is currency plus reserves. This is what's on the Federal Reserve balance sheet or is related to it. And you can see this behaved quite differently. That is, it was pretty flat, and it's really gone up quite a lot. That's quantitative easing at work. 2 minutes, okay? Yeah, I'm going to skip ahead, that part. So one of the things that everybody's worried about, not everybody, I guess, but lots of people are, they look at the Federal Reserve's balance sheet and they say, they have a lot of currency and reserves out there. Might that not cause inflation? This is a Zimbabwean $100 trillion bill. They had lots of inflation. You could buy 10 of these for $7 on eBay. That gives you some idea how much inflation there was. The brand new ones, not even used ones. So quantitative easing worries people because you have all this currency and reserves. This could turn into growth of the money supply. Doesn't have to, could. So what's my evaluation of it? Quantitative easing, I think, can't accomplish the goal of lowering the unemployment rate substantially. I don't think the Fed can change the unemployment rate predictably, actually, all right? But at the very least, quantitative easing is unlikely to have any big effect on the unemployment rate. If you want to affect the real economy, it's a particularly poor way of doing it. Larry talked about the Federal Reserve as credit allocator, all right? I think that's a really bad idea, because it gets the Fed involved in allocating credit across sectors of the economy. That puts it in a very different position than just being a central bank in the sense of controlling inflation. So it seems to me like quantitative easing is running a large risk for a smaller non-existent effect. Now, the financial crisis itself, could it have been handled better? The answer is, well, sure. It's always easier after the fact. The fact is, people did the best they could given what they knew. And that's the good news and the bad news. You know, the good news is they're not malevolent. They weren't trying to make things worse. They were doing the best they could given what they knew at the time. It's discretion, which is undesirable in itself. So how about all these actions that were taken along the way? What do I think about those? Bear Stearns, this is a big thing. Bear Stearns, Lehman Brothers, and AIG were inconsistent. Arguably, this was the single biggest problem in everything that occurred. All right, lots of people. Some people think about this a lot. Most people don't think about it at all. Bear Stearns was the creditors were bailed out. The stockholders got some value out of it. Lehman Brothers was allowed to fail. AIG was an insurance company. It wasn't even a bank. It wasn't even an investment bank. It was bailed out. It was bailed out the day after Lehman Brothers was allowed to fail. At that point, all you could say was, what are they doing? I don't know. This is exactly what you don't want during a financial crisis, is people are uncertain. They're already uncertain. You're making them more uncertain because now they don't know what you're going to do. Now, most of the people I know at the Federal Reserve say, so we should have bailed out Lehman Brothers, obviously. I go the opposite way and I say, no, they should have all been allowed to fail. How about TARP? I only have 2 minutes, but it's pretty. Oh, I have 1 minute. Well, I had 2 minutes. I had to.
That was 4 minutes ago.
Okay. It's professor minutes. I'm not a central banker anymore. I don't have to quit. No, I'll quit. Okay? There were a bunch of liquidity programs. The Federal Reserve intervened to provide credit to money market funds, for example. It provided commercial paper funding to firms. All right? Why? Well, because you had this big spike in commercial paper rates. People were streaming into government securities. So the Federal Reserve provided an alternative source of doing that and provided more government securities for people to hold, which is not obvious, and it was temporary, by the way. Now, TARP, I think, was a terrible idea, and it wasn't any better in execution. Quantitative easing, purchases of mortgage-backed securities and long-term treasury securities. I think the issue there is what you have to think about is do you want the Fed to be a credit allocator or not? If you want them to be a credit allocator, this is a great deal. If you don't, it's not. And it's really that simple. Okay, so I think the Federal Reserve should focus on inflation. And I think one thing to be aware of is any kind of fix, restricting behavior in a crisis is hard to do. The thing is that if you're in a policy position during a financial crisis, you have lots of things going on. You're not any more sure than lots of other people about what's going on. You're not really sure what's going to happen next any more than other people are. And you're going to try to do the best you can. That's not necessarily a good thing to have people doing, actually. All right? But that's what people are going to do, and that's actually what they did. All right? Thank you.
Thank you, Jerry. We do have time for some questions from the audience. If you guys we follow a microphone coming around, and just if you could state your name and affiliation, go ahead. I'm going to leave this entirely up to our microphone guys. I'm not picking anybody. Go ahead, Jay.
J.W. Barrett at House Financial Services. The meeting opened up with a discussion about what the Congress is doing and what the Congress knows about monetary policy, and I can tell you that I work for the Financial Services Committee and lead up the Fed oversight effort this year, and we've been informed by the writings of these three scholars in a big way. And in fact, I think we've had Larry up to testify so much we're working on getting him at least a cubicle up on the Hill. My question is with respect to some of the points of criticism today and the path for the future, it strikes me that reform efforts have to be holistic, have to look at all three legs of the Fed's role as the lender of last resort, as regulator, increasing role as regulator, and then monetary policy. And just to summarize what I think Chairman Hinchling has talked about in public speeches already, what we're looking at is essentially something very simple and something not new, encouraging the Fed to use rules-based policy, no matter what that rule might be, if it's in GDP targeting or the Taylor rule or the McCallum rule or something else. I don't think we feel qualified to choose a rule, but to encourage the use of a rule of some kind, which I think if you look at the press release from today's FOMC meeting about their latest idea about guidance, I think it's underwhelming, even more underwhelming than the previous threshold approach. So looking at that, but also looking holistically at the other three roles as well, and constraining the lender of last resort function, and particularly the use of 13.3, which is incredibly, I think, dangerous, and also a cost-benefit analysis requirement for the Fed, a statutory cost-benefit analysis requirement for the Fed's rulemaking, that opens up a possibility for judicial review. The other financial regulatory agencies have said, oh, this is too much, we don't have enough economists on staff to do this. I certainly don't think the Fed can make that argument. So I wonder if you sort of agree with that general idea that it has to be holistic. It has to look at a statutory constraint on all reasonable statutory constraints on all three functions of the Fed, because they, the boundaries between those, at least the way the Fed has operated, have not been, clear. The macro-prudential regulation limits the transmission mechanisms of monetary policy in some ways. Certainly, I think there are arguments about that with Volcker and Basel implementation. The lender of last resort function and the monetary policy function blend together. The extraordinary lender of last resort role in 2008 has become the day-to-day monetary policy of today. So I just wonder if you sort of generally agree or generally have any comments about that approach. It's great to have you guys here to kind of comment on that. As I can read what you've written, but I can't always ask you questions in the day-to-day. So I'd love to get your information and advice and continually as we go through this process.
Sure, I'll answer that first, because I have a strong opinion about one part of it especially. I agree in general. The one thing I think, though, is that the rule has to come from Congress, or it's not a rule. That is, for example, if Congress says your goal is to hit, here's the way it works in New Zealand. It doesn't have to come from Congress directly. It could come from the administration. It can be, we want 2% inflation. If you don't hit 2% inflation, then various legal, statutory, bad things will happen to you. You will lose your job if you're the governor, for example. That is, there are consequences of failing to do this. All right? That's not a rule in the sense it says what to do every day, but it says what the goal is. See, what the setup we have right now is we tell people, oh, you're on the board now. Do good things. It's like nobody gets on the board to do bad things. You could imagine it, but I don't think that's true. And so the rule, in the sense of the policy goal, has to come from Congress, or it's not a constraint. Because then it's, well, we'll keep 2% inflation as long as we want. Or we'll keep quantitative easing until the unemployment rate is 6.5%, unless we change our mind. And so it's not a constraint. Whereas if you say 2% inflation, that's a constraint.
This is the Meltzer proposal. At least Alan takes credit for that.
Yeah, well, I'm sure that I'm not surprised I agree with Alan Meltzer. Independently. He's not surprised he took credit. I had to say that.
That was sotto voce.
Yeah, I know it was. Yeah.
Not anymore.
Anymore.
If I can make a comment on this, that I think that the case for rules in monetary policy has been driven home so well so often that it's hard to add much to what's already been said, except to say that nothing in the recent crisis contradicts the merits of undermines the merits of the usual arguments. But I want to say something about rules for dealing with crises, which is related to some of Jerry's comments in his talk. Because it seems to me that Jerry said, well, that the Fed did the best that it could, given the knowledge it had. And then he went through a litany of innovative things the Fed did, almost all of which didn't do any good and may have been counterproductive. As I see it, the Fed did a very bad job precisely because there were some established rules that the Fed pays lip service to when it talks about how to deal with crises, particularly Bagehot's rule about lending to solvent institutions only, freely, to keep them liquid when they're illiquid, but otherwise refraining from providing what would be bailouts to insolvent ones. That's the rule that they pay lip service to. But instead of abiding by it, they did everything but. And in fact, it's a fact that hasn't been mentioned in connection with the discussion of the crisis. For the very crucial first period of the crisis, around the time of Lehman's failure, the Fed was buying up subprime securities and sterilizing those purchases, which meant that it was taking credit away from solvent institutions in order to provide it to presumably insolvent ones. And it was just as it was doing this sterilized lending, right? That's shunting credit to the insolvent, which means taking it from the solvent. Just as that was happening, that nominal spending in the economy began its collapse. And that's what takes the financial crisis and turns it into a recession. So it's when the Fed innovates in monetary policy that the biggest mistakes are made, and it's also when the Fed innovates in crisis management that the biggest mistakes are made. We need rules for both, and there are good rules out there that could be applied, and the Fed itself endorses some of them. It just won't stick to them for political or other reasons, and that gets back to the point about Congress. The Fed has to be made to follow rules, including even the ones it thinks are a good idea.
I would just endorse what Jerry and George just said and add to JW's comment that, I mean, the Fed will use whatever avenue to exercise its discretion is left to them, so it does need to be a sort of comprehensive set of constraints. I mean, they'll describe it as monetary policy if you'll accept that, and if you won't, they'll describe it as lender of last resort policy. But when in both cases, it's really credit allocation policy. That sort of avenue needs to be constrained. And I think you're absolutely right that 13.3 of the Federal Reserve Act has been stretched beyond the breaking point.
Rules are needed to stop the mission creep, which is really outrageous in this case and especially scary. And it's not just about the size of the Fed's balance sheet. It's about the size of its implied powers based on what it's allowed to do that it's never done before, and there seems at present to be no limit on that at all.
Thanks, guys. I have one question over here, and then I have another one. Okay.
Hi, I'm Diane Katz. I'm a research fellow here in regulatory policy. Just to follow up on your point about mission creep, I'm interested in what you think the likely consequences, unintended or otherwise, are going to be of the Fed's new regulatory, role of so-called systemically important financial institutions.
Well, my biggest thought about that is that the one thing that the Fed could usefully have done with regard to this notion of too big to fail, to call it that, would have been to, first of all, specify what everybody's been asking it to specify for a long time, which is what exactly makes a firm too big to fail, so we can know. And the other thing it hasn't really dealt with is the complementary proposal that once you can identify the too big to fail firms, you've got to hold them to special rules precisely because they're the ones that might take advantage of your willingness to support them even if they become insolvent. And you need to be reined in and their risk-taking activities limited. The Fed, as far as I'm aware, hasn't addressed these fundamental questions, and so everything else it does is baloney, because those are the problems. And so I think that this to me is very clear. The rest is just rearranging deck chairs on the Titanic.
Where's Rob? Okay.
Hi there, I'm Andrew Langer with the Institute for Liberty. Also have a question about mission creep and about the work, sort of the other end of the spectrum, the high-risk, short-term micro-lending industry and the administration's attempts to ameliorate risk in that regard. Hoping to get, sort of moving away from Fed policy, but hoping to get your thoughts on the move by the administration to make post offices and community-based lending institutions the new short-term, high-risk micro-lending industry in America.
What could go wrong?
Well,
What could go right?
this seems to me like a peculiar idea. About 10 years ago, Japan went the opposite direction. They had the world's largest postal savings bank, and they finally privatized it in order to get a little more efficiency into their lending system. So having the post office be your intermediary doesn't seem to me like a way to promote efficiency in the allocation of resources.
They've got to do something when there's no more mail to deliver.
Rob.
My name's Howard Segermark. I'm with the Committee for Monetary Research and Education today. Larry mentioned the question of velocity shifts right in the middle of the crisis. Some of us refer to that as demand shifts for monetary balances. To your knowledge, is there any indication of the Fed's ability to judge those shifts when they're happening And isn't it rather a crucial area, particularly when we're in a period of monetary policy instability, when the markets can sophisticatedly react rapidly to perceived or real policy changes, velocity or demand for monetary balances may shift rapidly.
You brought up the philosophy.
Well, okay.
It was a question to you, you know?
It's a difficult problem, and of course, it's a problem that Milton Friedman talked about long ago, and his judgment of the historical record was that the Fed has shown that it tends to react too late and in too great a magnitude after the fact to velocity shifts, and so has actually introduced more variation into the economy than they would have if they had followed a steadier monetary path. But nobody has the ability to forecast changes in velocity. It's not that the Fed has markedly worse forecasters than the market has. So the problem is to have a monetary system where you don't need somebody to forecast velocity in order to have monetary stability. In particular, if you make inflation more predictable, you get fewer swings in velocity. Now, the financial crisis was not due to that. It was due to people sort of pulling in their horns. And you would like to have a monetary system that will provide more liquid money balances when people want to hold more liquid money balances. And central banks have a very hard time forecasting that. To talk about having a system that relies on some other mechanism would sort of take us sort of beyond the realm of trying to patch up the Fed. But I don't see how you're going to solve that problem within our current institutional arrangement.
Well, there is one set of proposals that's gotten a lot of attention that at least improve upon some other monetary rules that have been popular in addressing the problem of velocity, and that's the proposals for targeting nominal income, or for having a rule that is a rule not for the price level, not for the money supply, but for the total volume of spending that the economy is supporting. And if the rule calls for the Fed to stabilize that volume or its growth rate, implicitly it's calling for the Fed to act to offset changes in velocity with changes in money growth, so as to keep the product of the two relatively stable. Those rules are not able, of course, to provide a way to forecast changes in velocity, but at least they allow the Fed to respond after the fact to such changes in a way that prevents them from causing trouble.
Maybe time for one more.
My name is Mary Lisson, and I'm an independent observer. My question is about the effect of U.S. monetary policy on the crisis right now going on in Ukraine and Russia, and the monetary policy of Ukraine with the introduction of the West introduced by the West, hryvnia, I think it's called. What effect do you believe their monetary policy has had on this crisis? And was it a big mistake to introduce that currency? And why is the European Union not allowing Ukraine to adopt a more dominant and more reliable currency, meaning that the United States currency is obviously dominant in the world, as is the pound, I think the Swiss franc. In Africa, I believe there are at least a couple of countries, if not, I think it's Mozambique or Zimbabwe, that doesn't have any local currency, and they're just using the pound, the dollar, the euro, and I don't know, China might be coming in. So yeah, in general, I would like you to kind of elucidate a little bit. And because my belief is that had they not introduced that currency in Ukraine, things might have been more stable.
I think that the man who knows the most about this is sitting behind you. That's Kurt Schuler, who knows all about the the Ukrainian setup. I don't think that U.S. policy has much influence now on what's going on there. Kurt, do you?
Well, Americans were advising all these
Yeah, but
breakaway republics, right?
A country that cannot establish its own currency in a credible way is generally, I don't know enough about the particular situation in Ukraine, but that would seem to be the case, is generally well advised to adopt an external currency of a major trading partner. And for Ukraine, it seems to me that would be the euro. And so sort of euro currency board, as has been adopted by Bulgaria to good results, sounds like it would have been a more sensible move to make.
See, the point is that you can use the euro without being part of the European Monetary Union, and countries do. And so you could, instead of using, I don't remember what they're called, instead of using the currency in Ukraine, you could use euros. There's nothing to prevent you in terms of, nobody in the European Monetary Union is trying to prevent other countries. They kind of don't like it, actually. But they're not really trying to prevent other countries from using it, and they wouldn't prevent them from using it. But entering the European Monetary Union is a different question.
Okay, I'm gonna do this. We're gonna close everything down with just one of our online questions, and we can, if the panel wants to weigh in on this, because I think it's a pretty good question, and then we'll be done. So this comes from Chris Alexander, who asks, do you think the increased transparency of the Federal Open Market Committee conversations has had a significant impact on guidance in a positive or negative way? I don't know if anybody wants to weigh in on that.
I can be first or last, either way.
Go for it, Jerry.
Okay. All right, so there's been a big push. This actually goes back to Greenspan a little bit, but not so much. I mean, he was really great at Greenspan speak, which is, you could say something and nobody would have no idea what you said, but it sounded very profound. And he kind of did that on purpose, because that way he could do pretty much what he wanted. Bernanke actually had a very different purpose. Basically the thing is monetary policy is actually more effective if people know what you're going to do in advance. That is, what you're going to do in the future can affect what people do today. Now, the issue that arises with that is a couple of things. One of them is, how do you communicate that to people in a way that they can understand it? You know, the way we talk about it at my house is there's economists and there's regular people, you know? And you want to communicate with regular people, the non-economists of the world. And so it can't be in some kind of gobbledygook that nobody understands. And then the issue that arises for a central bank, and that's just arisen recently, is, well, suppose that you decide, say, well, we're going to do this in the future. Now, what you really mean is as long as things kind of go the way we think they will, this is what we're going to do. But if something happens really different, then we're going to go off and do something else. And if you give people, you know, I'm going to do this, but maybe I'll do that. Well, maybe I'll do this other thing. You know, you haven't communicated anything at all. And so you end up having to communicate sort of a central tendency or what you think you're going to do. But you might change your mind, and then that dilutes the whole effectiveness of the whole exercise. Is the problem you run into. And they've run into it.
Yeah,
I would say it's a poor substitute for having a rule that constrains the Fed to do what it's supposed to do. It may help people predict what the Fed is going to do. I haven't seen evidence one way or another, but having the Fed constrained to follow, say, a nominal GDP target or a price level target would be much more effective at letting people forecast the effects of monetary policy.
I agree with what Larry said. And transparency, as it's called, in the context of ad hoc policy making can be a recipe for real trouble. Some of the worst things the Fed has done in recent years, including its response to the dot-com crisis, have consisted of it making long-term commitments in a seemingly transparent way that it then later had some reason to regret. And if you read the transcripts, you can see them struggling, saying, well, we said we would do this, so we have to keep doing it, even though they can see the signs of trouble coming. So a rule would avoid this kind of thing, would allow the Fed to do exactly what everyone expects it to do, to be very transparent, without having to second guess what future conditions will be.
Okay, thank you. I want to thank our panelists for coming and thank all of you for coming too.